For much of the past year, investing in the stock market has required an iron stomach. The fact is, however, that many people lose money and lots of it during a stock market crash, but it does not have to be so. If you make the right decisions in a falling market, you can profit handsomely. Today, we'll check out the stock market crash of 2021, analysis and how to profit. Number 7. Is the stock market going to crash in 2021? We need to establish one important fact. No one can accurately predict whether or not the stock market is going to crash in 2021. Just think back to everything that happened last year. You can't make this stuff up. All we can do is evaluate which indicators will influence the market and your investments in the coming year. The good news is that overall, major financial analysts are predicting steady growth of the bull market in 2021. But let's look at the specifics. Reasons to feel cautious about the stock market in 2021. COVID-19. The coronavirus isn't going anywhere, and new strains are developing. Unemployment. Although we've added millions of jobs since the country was hit hard in 2020, we're still experiencing significant unemployment numbers. Inflation. Those stimulus checks come at a cost. With increased government spending, we'll probably see an increase in inflation, which could lead to investors pulling back. Reasons to feel optimistic about the stock market in 2021. Vaccinations. As more people are vaccinated for the coronavirus, we'll see an increase in optimism, movement, and spending. There's a lot of pent-up energy in the country, and people are ready to get out and about. Old industries reopening. As the world continues to reopen, we'll see certain businesses gain value in their stocks again. Think oil, travel, and entertainment. New industries growing. Specific industries, tech, e-commerce, and biotech gained tons of ground during the pandemic and will continue to grow and give investors reason to feel confident. Low interest rates. The Federal Reserve has promised to keep interest rates near zero, which will encourage spending. Number 6. Be prepared for a 20% stock market crash. While most analysts are optimistic of 2021 to be a year of bigger gains, after investors raked in much this year despite a pandemic-related crash, a debate still stands on if stocks will collapse this year. Although day trading and momentum chasing seem to be ruling the roost in the first few weeks of the new year, it's operating earnings growth that drives equity valuations sustainably higher over the long run. That's why it's always important to pay attention to market-based fundamentals no matter what's going on. The figure that should have investors pretty concerned is the Shiller price-to-earning PE ratio for the S&P 500. This differs from the standard PE ratio in that it's based on average inflation-adjusted earnings from the previous 10 years, as opposed to just earnings from a single year. Looking back 150 years, the S&P 500 has averaged a Shiller PE of 16.78. Admittedly, the Shiller PE ratio has been a lot higher over the past 25 years. The advent of the internet has broken down information barriers for retail investors, and historically low lending rates for more than a decade have fueled borrowing and lit a fire under growth stocks. But as of February 3rd, the Shiller PE for the S&P 500 was knocking on the door of 35, more than double the long-term average. To put this figure into some context, there have only been 5 periods in history where the Shiller PE ratio topped 30 and stayed there during a bull market run. Number 5. How to prepare for a stock market crash in 2021. Some investors think the best way to prepare for a stock market crash is simply to sell almost everything at the slightest hint of trouble, or they panic sell after their stocks are down 20 or 30%. Don't do those things. Instead, take a hard look at your portfolio now. Consider selling the laggards. You might also want to lock in some profits by selling off a portion of your big winners, stocks that are up 100% or more. Both moves will create some dry powder, a little cash to keep on the sidelines. You'll also want to make a shopping list of stocks you'd like to own but are now overvalued. When a crash happens, you can use your cash to snap up these stocks on sale. Another smart strategy is to tighten your trailing stops. A trailing stop will trigger automatically if a stock falls by an amount or a percentage you specify. That can limit your losses on days when the markets go hard down. Putting a portion of your money, 5% to 10%, into hedge investments such as gold and Bitcoin can also help migrate losses. Bitcoin has the additional advantage of having extraordinary upside potential. Finally, investors should make sure they have money in areas that will best weather a stock market crash, while offering the prospect of strong long-term returns. Those areas include value stocks as well as emerging market stocks. Investors should seek out funds that combine both, such as the American Funds Developing World Growth and Income Fund. Number 4, stay the course and target winners. Nevertheless, even if a stock market crash is brewing, it's a smart move for investors to stay the course and add to innovative and winning businesses. One of the most telling statistics about stock market plunges comes courtesy of J.P. Morgan Asset Management. Having analyzed 20-year rolling returns for the S&P 500 with multiple different end years, one figure stands out. Roughly 50 to 60% of the market's best single session gains occur within a few weeks of its worst single session performance. This is a fancy way of saying that if you run for the exit, you're almost certainly going to miss out on some of the market's biggest up days. Missing out on even a handful of these big up days can be detrimental to your wealth. Additionally, data from Crestmont Research shows that there hasn't been a trailing 20-year period in the S&P 500's history where investors would have lost money. If an investor purchased an S&P 500 tracking index and held on for at least 20 years, they typically averaged a high single-digit or low double-digit annual total return, i.e., including dividends. If a stock market crash rears its head in 2021, the best game plan is to stay the course and add to holdings that keep winning. Number 3, how to profit from a bear market. The simple and easy way to profit from a stock market crash is to do one of the hardest things in life: nothing. Don't just do something, stand there, is the best strategy, in my opinion. Of course, this assumes that your asset allocation plan is appropriate for your investing horizon and risk tolerance. It also assumes that your investments have gone down because the market has gone down, not because you invested in some silly .com company with no revenue. So that's what I've done. I've not changed my asset allocation plan. I have continued to invest on a regular basis just as before. I've only sold one fund, and that was for tax reasons. The proceeds will be going right back into the market to maintain my asset allocation. That being said, there are some strategies you can take if you want to accelerate your path to financial freedom during a bear market. Number 2, if you're investing, stay invested. The most basic principle of investing is to buy low and sell high. When stock prices dip low in a crash, I want you to think of it as buying on sale. Don't try to time the market. Focus on time in the market. If you're on baby step 4, keep investing 15% of your income, unless you need to pause temporarily due to unstable income. Lots of people are tempted to cash out their 401k or mutual funds when the market takes a nosedive before they lose any more money. But if you pull out now, you guarantee a loss. Stay plugged in and ride it out to give your investments more time to grow and recover. Number 1, look for stocks that pay dividends. While the stock's price is dictated by buying and selling in the stock market, a dividend comes from a company's net income. If the stock's price decreases, yet the company is strong, making a profit and still paying a dividend, it becomes a great option for those looking for additional earnings. Finding dividend-paying stocks is one of the core tenets of value investing. Just make sure you know what you're looking for and don't just pick a random stock because it pays a dividend. There is a method behind the madness here. It's useful to research past bear markets to see which stocks, assets, or sectors actually went up, or at least held their own, when all around them the market was tanking. Numerous financial websites publish sector efficiencies for different time frames, and you can easily see which sectors are presently outshining others. Start to designate a few of your investment dollars in those sectors, as when an industry does well, it typically carries that out for an extended period. Bear markets can also have various catalysts, so this strategy can likewise help investors to designate their investments accordingly. Do let us know in the comment if you have experienced any stock market crash ever before. Please subscribe to the Stock Advisor. Thanks for watching.